Hi folks, here are again another Tuesday evening. Hope everybody is well. Enjoyed some of the pre-show chat, and pleased to say that Leith is here, of course, to join us very shortly. Here's the studio. Leith is teed up, ready to come in, and I think we're going to have a really interesting conversation. Leith is well oiled with regards to these recent conversations. He's done so many, so I'm glad that he's with us today. Doggies are here as well. They've had a bit of a sprawl, so I had to move the camera slightly, but they'll be hopefully quiet. But as with dogs, sometimes they get a bit excited, particularly when the bin man comes. So we will see. Anyway, we're going to have a really interesting conversation today about all things to do with the budget, property, housing, and some of the broader issues too, of course, because there's a lot of questions that I think we need to spend some time thinking about. And specifically, is the 30-year property super cycle over? Well, we'll see. Anyway, we've crossed the watershed. Let's turn the pre-show off. I'll start the shed back in just a second. Well, good evening and welcome to this live stream on the 19th of May, 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for taking time out of your Tuesday evening to spend it with us. Really appreciate it. And hopefully we'll have an interesting conversation, as we always do with Leith. He's one of my most popular guests, along with Tarek and Tony Lacantro. So I think we should hopefully get some good numbers. Please remember to like and share. Just before I bring him in, I'll also remind you that we're not providing specific financial legal advice. We moderate the chat, but do feel free to throw questions, comments in as we go. If you use that Walk the World DFA, that'll get my attention and into my queue. I've enabled Super Chat, which means if you want to get your question to the top of the list, you can do that. Or indeed, make a contribution to what we do around here. Really appreciate all those who support us. We don't do this for profit. We do this because we think there's a really important conversation to be had. And those who support us via Super Chat, PayPal, and Patreon, we really appreciate all of that support. It makes a huge difference to us being able to do what we do. Right, let me bring Leith straight back in. Hi, Leith. Nice to see you again. Welcome back.
Yeah, g'day, Martin. Thanks for having me back. It's it's been an eventful few weeks, I think, since the last time we chatted. It was only about 3 weeks ago, I think. And look, mate, since that, we've obviously had a federal budget. We've got a housing correction. Another interest rate hike. There's all sorts of stuff going on at the moment, so it should be a really good chat.
Yes, absolutely. And I booked you deliberately this week because I wanted to get you the week after the budget. So once everything had settled down a bit, and I've been amazed by the volume of commentary on all aspects of the budget. I mean, pretty much everybody's got an opinion, right? Not necessarily an informed opinion, right? And it's fascinating to be Richard Wiles from Morgan Stanley. Richard and I, years ago, we used to jointly produce the JP Morgan property report with DFA. So Richard and I go back quite a long way. And what was interesting about Richard's comment was that he thought that maybe we are actually going to see the end of the 30-year super cycle for housing. And he was linking it back to the banks lending. Of course, lending has been massive over recent years. And maybe that this is what the government wants, but maybe also people don't want to recognize that actually the super cycle may be ending. And then I saw this from Alex Joyner, who actually showed the massive acceleration of dwelling prices compared with price income and inflation. And, makes the point, if prices fell a bit, it would still be excessive. And I guess, Leith, my perspective is you need to go back 30 years or so to understand the seeds of our own destruction here. It wasn't just CGT and negative gearing, but it was also the deregulation of the banking system, the introduction of securitization, the multiples, variations that lenders were able to do, and a bunch of other things, and a lot of other government policies too, and money being thrown then at first-time buyers, and we can go on and on. The point is, we've got ourselves into this position due to a lot of really bad decisions over a long period of time.
Yeah, and look, it really has been a 30-year perfect storm, hasn't it? So, and look, I agree with that assessment that it's, looks like it's coming a cropper and it's probably going to end now, especially after the budget's tax changes and that sort of thing. And also, look, we I've got to be honest, it's Canada and New Zealand are going through a similar process right now. And again, I wish it's another time when I wish I'd put that chart in. I just forgot to do it, but there's a great chart that Justin Fabo, Antipati and Macro put up about a week or so ago, comparing the house price cycles across the developed world. And the two most similar economies to Australia, New Zealand and Canada, I'd argue, are both having very substantial house price corrections or crashes, if you want to call it, in real terms. So I do have some charts in New Zealand for later, but Canada's also had a huge housing bust as well. So look, we obviously are defying gravity at the moment, but and there are some different factors here. I mean, we do still have much higher immigration than those two countries, but at the same time, it's, I bet you a lot of people back several years ago, before the correction set in those two countries, probably thought that their housing markets were impervious to, housing crashes, but they're both now experiencing one. So, yeah, I think if we are to get a severe correction or a crash in real terms, probably now's the time.
Yeah, and I think it's worth highlighting that Labor, of course, talked about sustainable price growth in the last election round. And I always remember that interesting conversation. It was on the radio, wasn't it, with Claire O'Neill. And of course, Albo committed to not change CGT and negative gearing. And of course, well, there's a few questions now about that. And it's interesting that Claire O'Neill now has refused to make comments about the fact that some of those people who got the 5% deposit might actually end up in negative equity. So it is, will, exactly right. So we have, I think, seen a terrific example of significant government intervention. We don't have a free property market. We haven't had it for a long, long time. But every time they sort of try to do something over here, something else falls off the wagon over on the other side. And I've always had the view that the problem is that we have more and more government intervention. We also, of course, have a bunch of assumptions that are made into the budget. And we're going to spend a little bit of time talking about some of those assumptions because it tells you a lot about how the Treasury in particular and the politicians more generally are regarding the economy and also the role of taxation, particularly personal taxation, in the role of the economy.
Yeah, absolutely. I'll no doubt go on a bit of a rant later on about my beefs with the budget. So, there was obviously a few decent things in there, but there's also a lot of pretty bad stuff, in my opinion. And if I had to summarise the budget, I'd sort of say it was more a tax grab than tax reform, whereas I actually wanted proper tax reform. And, it's something I'll probably cover off in detail later. But and there was a few hand grenades in the budget as well which could actually harm the nation, startups and that sort of thing, with the new CGT changes. So, I wasn't that impressed with it, although I've got zero qualms and actually support the, removing negative gearing and tightening capital gains, the increase in, basically going back to indexation on capital gains for established housing. I think that's smart. I fully support that. But just some of the other things in the budget wasn't too happy about, which no doubt we'll get into a bit later.
Yeah, I tend to agree with you. I mean, we knew that something had to be done about the investor segment. Much bigger proportion of the total housing market than pretty much any other Western economy. It's double the size of, for example, the UK, which we're also worrying at 16% of property being for investors, and they've actually dialed it back in the UK quite substantially. The other point to make, I think, and this is something which I'm really quite annoyed about, is the government recently changed the tax regime positively to enable the rent-to-buy sector to blossom. And a lot of those big international corporations are now doing projects which are going to be build to rent. So the build to rent sector is now morphing from the domain of the mum and dad investor to the big corporate investor. And they've got a lot more tax breaks than almost anybody else. So I do worry about whether, in fact, this government is actually really doing things in support of ordinary people, or whether they are actually more coupled to big corporate land. And I'd perhaps put the gas tax or the non-gas tax on the same list, right? That they seem to be wired the wrong way, in my view.
Yeah, that's a good point, and I actually hadn't thought about that. So certainly with the build to rent, like, do we really want the BlackRocks of the world, these sort of investment firms basically taking over the rental market and having arguably more market power than a diverse range of, a million landlord mum and dads do? But also there's a bigger issue as well. So, a lot of those build to rents, they are building new dwellings, etc. But if you actually look at the rents that those build to rent properties rent out for, they tend to be about 25 to 40% above market value, like, the median market. So they actually rent, the median value of the rents on those build to rent properties is way higher than the broader market. So they tend to actually build more expensive properties. So, and admittedly, I know, for example, Damien Classen rents one of those, and I've been to his apartment. It's nice. And he has, they've got a nice pool, and they've got a gym and all this other stuff. So it is very well serviced, but it's sort of not catering towards the affordable end of the market. And if you're worried about rental affordability, you sort of want to be, catering more towards that affordable end of the market, rather than, building properties that are for wealthier people. Obviously, we need a diverse range of properties, so we should be providing rental stock of all different types. But I think, these sorts of rules are going to skew the market towards that more expensive end. And when you're dealing with, the worst rental affordability crisis in our lifetimes, whereby rents, according to Cotality, have risen by 50% since the end of 2019, you want more affordable rentals, not less affordable rentals. So that's a really good point you raised, and I hadn't actually thought about that.
Well, it's something which I think we need to think about, not least because I note that some of the recent projects, which ostensibly should have a proportion which are affordable homes bundled in, they've under-delivered on the affordable homes component of the projects. Why? Because it's impossible to build affordable homes at a price point that makes any sense. The only way that you can make these projects work is to build more flowery, more higher kitted out projects, which are attracting a completely different sector of the market. So, to my mind, it is another example of misplacing effectively government investment and spending indirectly via the tax breaks, of course, but claiming somehow magically that they can actually lift the number. The other little tweak here, of course, is the states are being paid on not on delivered properties, but on approved properties. And so there's a massive gap in my mind between approvals of properties and actually properties being built, delivered, and the keys handed across. Because it's too expensive to build with all the inflationary pressures that are in the building and construction sector. You can't get the workers. And in fact, if you look at a comparison of Australia versus other countries, we are building on a population basis a lot more than almost everybody else anyway. So our capacity to build more is very limited. So once again, when you start peeling the onion back, you realize that, again, this ain't going to work.
No, no, and that's another good point you raised. So there was an article came out a couple of months ago, I think, in the AFR, and actually profiled Western Sydney, or it might have been the Australian, one of those. And they said that in this sector area of Western Sydney, they'd approved something like 22,000 apartment homes, I should say, but only like a fraction of those, it was like under 10,000, have actually gone ahead to construction. So they've approved a bucket load of homes, but they're actually not starting construction on many of them because it's just simply too expensive, right? The developers can't make they can't build at a price that people can afford and that they can break a profit. And this all gets back to the fact that construction costs have risen about 40% since the pandemic, and now that we've got the global energy shock, costs are going up even further again. And a whole bunch of developers, I don't know if I mentioned this last time because it was certainly an issue a month ago, last time we talked, a whole bunch of developers around Australia have warned that their costs are rising. So there was Satterley Property Group, who's like specialises mostly in Western Australia, but they're the second biggest house and land developer in Australia. And they estimated that the cost of building a new house is going to go up by about $50,000. Like, so that, talking about a house and land package. Because the rise in diesel prices alone is going to mean that preparing a block is going to cost another 20,000. Then you got all the added costs in PVC pipes and masonry and timber and cement and all these other things that go into building homes. That's all rocketing in price as well. And we've seen the cost inflation across, Reece Plumbing, for example, has passed on a whole bunch of costs. All these suppliers are now jacked up their prices. And that just means that after this 40% surge in cost that we've had since the pandemic, we're likely to get another 10 or so percent at least. And once that gets added on top, it just means that it becomes even more expensive to build. Prices become, have to go above what people can afford. And there was one of the developers, Daycorp, actually, they said a quote, something along the lines of feasible projects have now become marginal, and marginal projects have become unfeasible. That's almost a direct quote, what they said a couple of weeks back, based on this cost inflation. So obviously, if the costs go up, you're going to build less, and it's going to make it even harder to meet the government's housing targets. And at the same time, and I'm sure we'll get into it, the government's still got the pedal to the metal with immigration. So that's just obviously crush loading the supply side.
Yeah, and just one other little factor to think about. It's interesting that when you look at new properties, and there's a bit of a premium when you buy new, but as soon as you go into it, that property tends to drop in value a little bit. Why? Because down the road, you can buy another new one because they're building that, just down the road. Now, if property prices are rising significantly fast, that may be not too much of a problem. But if we are now in a situation where the property market is going sideways or down, suddenly the idea of buying new is not that attractive. And I would ask whether, because of that, we are going to see an uplift in property investors piling over into buying new properties or, paying to invest in new properties, when in fact the economics of those new properties are already shot because of the inflationary pressures and the expectation maybe of price falls rather than price rises. So maybe we won't see a surge across to more new builds.
Yeah, and absolutely. The headwinds are massive, right? So you've got not just the construction costs I just mentioned, but you've got obviously higher interest rates, which makes it less profitable for developers to build. But then at the same time, we've now got falling property prices. So, all that means is that with prices falling, it's kind of the reverse of what happened during the pandemic, whereby builders signed fixed price contracts and then the costs went up and then they became unprofitable and a lot of them end up going out of business. It's the other way around. If a developer goes, okay, I can do a project at this, and they think but they're not sure what price they're going to sell because the prices are falling, it doesn't take much for the price to fall back. Like if it takes them a year to build something and they're worried that the next year prices could fall by 5 to 10%, which is possible, suddenly that project that they start construction on, by the time that it's finished construction, they'll actually make a loss on it. So falling property prices are terrible for developers and terrible for construction. And there's actually, I wish I'd charted, I might do it for next time. But if you actually plot, home prices against construction rates, they're actually, reasonably correlated, right? So when prices go up, you tend to get more construction. When they go down, you get less construction. And it's pretty logical why. Because developers in a falling market don't want to develop because they don't know what price they're going to be able to sell that property at in a year's time once they finish that development. And in the case of apartments, it's more like 2 years to build an apartment block. It takes a lot longer than an attached house. So that lag time is a lot longer. So if you're starting an apartment block now, or you're thinking about, starting one right now, and it could take you 2 years, you don't know what the housing market's going to be like in 2 years when we've got tax changes, interest rates going up, the markets are starting to fall. We've got broad-based property price declines across Sydney and Melbourne, and the other smaller markets, the growth is falling quickly, and they're likely to go into negative sooner or later. It's not conditions that are conducive to actually for developers to build more. It's a triple whammy. You got rising costs, rising interest rates, and falling prices, and also labour shortages as well. So it's a quadruple whammy. This whole notion that the government thinks that they can magically start boosting supply is just delusional because the macroeconomic factors just don't support it.
Absolutely. Well, we'll get into some of that, but let's sort of go down the rabbit hole a little bit. Should we start with where property prices are actually now and what the dynamic is, and then perhaps from there move into some of the budget issues?
Oh yeah, 100%. So I've got some charts I've put together. Some of these actually came out today by Justin Farbo at Antipodean Macro. So today we got the weekly consumer sentiment, consumer confidence survey by ANZ Roy Morgan, and you can see on the left-hand side, we got a tiny little bounce today, but you can barely see it on the map. You can see that ANZ Roy Morgan's consumer confidence survey, so that's a weekly survey, whereas the Westpac Melbourne Institute's a monthly survey, so it lags. But you can see that consumer sentiment or confidence, according to ANZ Roy Morgan, is tracking at close to its lowest level on record. Now, their records go back to the early 1970s. So they're pretty much at record lows, right? This week was up a tiny bit, but you can see on that chart, the black line, absolutely terrible consumer confidence. Next to that in the middle, they've actually got the household price expectations. Now, that's in the orange line. Now, obviously, they're still at a reasonable level overall, but they've fallen quite sharply, and that probably reflects the fact that house prices are falling. So people don't expect house price growth has tanked. So as a result, people now are obviously less confident about price growth. That's pretty logical. And on the right-hand side, this is the money chart. So this is Justin Farbo. He seasonally adjusts the Cotality Daily Index. Now, I was going to put my chart up here, but his is cooler because he seasonally adjusts it. I don't know how he does it. But mine showed similar. But you can see now that in seasonally adjusted terms, and actually in raw terms, they're also falling, but not quite as much. You can see that home prices across the 5 major capitals, that's the dashed black line, are now in negative territory. So the housing correction has officially begun. Across the 5 major capital city markets over the last 28 days, or monthly, home prices are now negative, and they're being pulled down by fairly significant falls across Sydney and Melbourne. So they're now falling by about 1% month on month. And the old strongholds of Brisbane, Adelaide and Perth, they're still growing, and Perth's still growing at a decent clip, but they're all turning downwards, right? So you can see the momentum's coming out of them, and that makes sense when you've just had 3 rate hikes in a row and you've got very poor affordability in those markets. And obviously, we've now had the federal budget's tax changes, which are going to smash property investors. Buyer demand's also stalling. So last week we got the housing finance data from the ABS, and that actually, so now it's quarterly, it used to be monthly, but we got the March quarter data. And across all the cohorts, so we're talking investors, first home buyers, and just non-first home buyer owner occupiers, housing finance commitments fell pretty heavily. And you can see on that chart again from Justin Farbo, he's plotted the quarterly growth in finance commitments against the monthly dwelling price growth. And as to be expected, they're very highly correlated. So obviously housing finance growth has now turned negative, and so is price growth. That makes sense. In the middle, I've got the latest final auction clearance rates. So last weekend's haven't been updated yet because we haven't got the final results yet. But I've done it as a monthly average, and you can see that in May so far, so it only captures the first 2 weeks of May, but I've done monthly averages there. You can see across the major capital cities that auction clearance rates have absolutely crashed. And historically, auction clearance rates are arguably the best leading indicator for house prices. You can see it's very, very, strongly correlated there. I've done the the monthly average against the quarterly price growth. And on the right-hand side, Cotality about a week and a half ago released their monthly chart pack, and it showed that monthly sales have now fallen below the 5-year average in both 6-month moving average terms and just in raw monthly terms. So what this sort of tells you is that buyer demand's falling, right? It's, buyers are now not competing for housing stock like they were previously, which is why I've got falling finance commitments, falling auction clearance rates, and falling home sales. So the floor's sort of starting to come out of the market now, and that's been reflected in lower house prices. And Cotality, about a week or so ago, it might have been a week and a half ago, they in their latest chart pack, they actually plotted the biggest house price declines recorded in Australia over the last 40 years. So this is nationally. And I think we're going to smash the 40-year biggest decline, because that was only 8.2% between 2017 and 2019. Now, if you think back to 2017 and 2019, that was when we had the Banking Royal Commission. We had the APRA curbs on investor mortgage lending, and the Labor opposition at the time, they went to the 2016 federal election proposing changing negative gearing and capital gains tax, and then they went to the 2019 election. And it wasn't until they got defeated at the 2019 election and ScoMo won that, the election that was, the impossible election to win, he won that we started seeing house prices rebound. So 8.2% is the biggest house price decline nationally in the last 40 years, according to Cotality. And I personally think this episode that we're now going into is going to beat that. And I wouldn't be surprised if it beats it pretty handsomely, because when you look at the factors that are combining, we've got record high housing valuations. So relative to income, mortgage payments to disposable income, years to save a deposit, whichever way you want to cut it, housing affordability has never been worse in Australia. So we've got massive overvaluation. We've now got a cash rate that's at 4.35%. We've had back-to-back rate hikes. The financial markets are still tipping 1 or 2 more rate hikes by the end of the year. If we get one more, that'll be the highest cash rate for about 16 years. And if we get 2 more, it'll be the highest in about 18 years. So obviously we've got a tightening mortgage market. And then we've obviously still got the global fuel shock and all those sorts of things, which are smashing confidence. We still have a risk of having diesel shortages in the next month or two, although right now it seems we're in this kind of calm period, which could smash the economy. And obviously home prices are already falling. And then we've got the budget tax changes. So this is just like a perfect storm for house price declines across everything: monetary tightening, weakening economy, major tax changes, which are going to smash investor demand. All these sorts of things are just conspiring basically to, I think, for Australia to have its biggest house price correction in at least 40 years.
Yeah, well, it's certainly looking like a downturn. How long and how deep, of course, is the question. It won't be uniform across the whole country. I suspect that some types of property will do better than others. The owner-occupied house is now sort of the last bastion of tax-free investments. So we'll probably see some people putting more money into those owner-occupied houses. But overall, it's a bit of a mess. And just a little input from me here, whether you saw this, but of course, the 5% deposit scheme has helped 250,000 Australians into their first home, coupled with now Claire O'Neill unable to confirm whether young Australians will plunge into negative equity due to Labor's new laws. The housing minister guaranteeing that prices won't fall would be insane. We are meant to have a market. And that's really the point, isn't it? Tarek's spot on with that. And that's really the point. So unfortunately, we've had a lot of people who have been led into the property market with the government incentives and, with the promise of the 5% deposit. And people are still, on the view, well, property prices can only ever go up in Australia. Well, yeah, but they have fallen, as that Cotality chart reminds us. And as you say, we're at a very precipitous position at the moment, because pretty much all of the metrics, whether you look at leverage, how amount of debt across Australian property, whether you look at the income to price ratio, or all the other dimensions too, it just makes sense. And of course, the rental sector is also under huge pressure now with significant rises in the rental sector and lack of supply. And we still have the high migration going on at the moment. So it's a real mess.
Oh, absolutely. I mean, um, yeah, it's an absolute shocker. And CBA actually, well, I mean, the federal budget obviously upgraded net overseas migration. So it actually upgraded migration over, and Tarek's done a great chart on the top here, which just basically shows how much previous federal budgets have missed on migration. So pretty much since the Albanese government came to office, every single federal budget that they put together has promised one thing in migration, and then the realities ended up basically, kicking them in the butt. And you can see that you can see the upgrades to net overseas migration from the 2022-23 budget all the way up to the later budgets. Every single time they've missed, and every single time the migration forecast has come in stronger than what they anticipated, and this time was no exception. So the federal budget last week upgraded net overseas migration versus the MyEFO in December and last year's federal budget by 55,000. So all of a sudden, they now expect 35,000 more net overseas migration this current financial year and another 20,000 next financial year. And that, of course, means if you've got 55,000 more migrants than what they were expecting, that means 55,000 more people who need housing. And almost all those 55,000 people, that extra people, will rent. So it's just that, it just adds to this whole lack of supply dynamic. It comes at the same time as the rental vacancy rate in Australia is tracking at close to its lowest level on record. And we've seen, as I said before, a 50% spike in rents since the end of 2019, with most of that in the last few years. And rental growth is re-accelerating according to Cotality. So rents are now rising at more than 5.5% per annum, which is well above wage growth. And it's re-accelerated. And it comes at the same time as CBA have just released their, about a week or so ago, released their latest dwelling construction forecasts. And that's the chart on the left. This is their base case. They actually had a worse case than this, but I didn't bother putting it in here. And CBA thinks because of this global energy shock, which obviously, as I said, has lifted the cost of inputs into housing, they now think that Australia is going to build less houses than they thought previously before the Iran war. So you can see the yellow line there was their pre-Iran war construction forecast, which was still poor. And now they've downgraded that to the blue line. And you can see where Albo's housing target is there on the left-hand side chart. It's right up there at 240,000 a year. That red dashed line at the top there, a level of construction that Australia has never achieved before. Even during last decade, so between 2015 and 2020, when we had that high-rise apartment boom where we built all those crappy 2-bedroom, 1 and 2 bedroom bedsit apartments with leaky balconies and flammable cladding and absolutely terrible quality. Even during that period, when we had a cash rate of 1.5% versus 4.35% currently, the best single year of Australia's housing construction in history was about 223,500 in 2017, which is the very peak of that black line. And that was 7% below the annual average that the Albanese government forecast over 5 years. So we have a government that is completely delusional, that is completely gaslighting us, has set a target for construction that was never possible even under ideal economic conditions, let alone a 40% increase in construction costs, a massive rise in interest rates, labour shortages, and now the oil shock and war in the Middle East, which has raised input costs. And according to CBA's forecast, they forecast that over this 5-year housing accord period, whereby the Albanese government's forecast 1.2 million homes over 5 years, CBA reckons we're going to miss that by about 325,000, or it might have been 340,000. It's one of those two numbers. So we're not even going to be close. We're going to miss it by about 26 or 27%. So we're not, this is clown show stuff. And just to top things off, on the right-hand side, put another chart from Justin Farbo, which he actually put up today, on construction, on insolvencies. And you can see the construction insolvencies there, the black line, have picked up again. So we had this period after COVID, and and I mentioned this before, whereby a whole bunch of builders lost heaps of money because they engaged in fixed price contracts under home builder. So if you take a walk down memory lane with the Morrison government, when COVID hit, they basically brought in this home builder stimulus whereby they subsidised people billions of dollars to go out and build new homes thinking it was going to help. The problem with it is people signed the contracts to build the homes and then costs soared by 40%. And what that meant is that these contracts were predominantly fixed price contracts. And it meant that developers were locked in to produce a home at this price, which they thought was profitable. But then when costs went up like that, suddenly they were making losses. They're making big losses. And as a result, we saw a huge number of construction firms go bankrupt and basically leave. And now we're starting to see, like those construction insolvencies never really came down. They came down slightly last year, but now they're starting to go up again. And, you know, again, a whole bunch of developers have warned that this new surge in construction costs, thanks to the war in the Middle East, is likely to send a whole new round of builders broke, right? Now, again, these aren't conditions that are conducive to building more homes. If anything, Australia is going to build less homes in the next several years because of these costs, high interest rates, you know, builder insolvencies, falling prices, all these sorts of factors, and rising construction costs because of the oil shock. So, yeah, it's not the right time to be basically revising up immigration, which is what the government's done, into a housing crisis. It's into a supply crisis. They're absolute morons. And as a result, the rental crisis is going to roll on.
Absolutely. And a greater proportion of people are renting than ever. The numbers, of course, are all-time high. The number of people who own their property outright continues to fall because more people have mortgages, and those mortgages are bigger. Those mortgages are also now going to be subject to higher interest rates, as we discussed earlier on, and so they're going to be paying more of their disposable income to effectively support their mortgage, or indeed, if you're in the rental sector, the rents. And I see that in my surveys and in my rental and mortgage stress. So we have an economy at the moment that is absolutely squeezing a lot of households. Now, there are some doing well. That's, you know, not a problem, but there are quite a few who are not. And looking at the sort of the assumptions in the budget and the way that the budget was formulated, it seems to me that this was, one, a cash grab. Two, it was dressed up as something to support the housing agenda. But three, it's not going to do much at all to actually solve the insolvable housing agenda if you start from this point of view, which is want to build some more stuff. Well, actually, the chances of building more stuff is zero.
Yeah, and at the same time, you're pumping demand with more people who need more stuff to be built. So it's it's crazy. So they're continuing to pump demand with high migration, and again, it's been upgraded by 55,000. At the same time as supply has just been absolutely choked, and that's a very bad equation if you're somebody who is renting, or you care about supply and you care about affordability. High demand into a supply constricted market, into a market that's becoming more supply constrained, is a recipe for disaster.
Mm. Yeah, and this is what I think was worth highlighting. Why is it that the migration numbers have been kept up? I mean, there is a logic that Treasury will argue. One, we need more workers in Australia. Businesses, of course, want more workers. We've got certain sections of the construction sector that want to sell more stuff to those people coming in, so they're very keen to advocate that. And of course, a bigger tax take, because you have more people who potentially might be paying tax if they do actually work. But the migration story is actually very deceiving when it actually looks at the economic value to Australia and the benefits of Australia. It actually doesn't bring more value to Australia.
No, especially the quantum and the quality that we've run the migration system. So obviously we've run a migration system for 20 years that has been in excess of the nation's capacity to build housing infrastructure and also business investment. I don't have the charts with me, unfortunately, but we have experienced what's called capital shallowing in the past decade, especially, but really the last 20 years, whereby we've grown the population faster than we've had private business investment, as well as infrastructure, and then plus housing. And what that's meant is that the capital stock of the economy has been diluted by, hasn't grown as fast as the number of people have grown. And that means that per person capital stock has shrunk. And that may ultimately makes you less competitive, less productive, and also ultimately lowers living standards, right? Because you've got a higher percentage of people using for example, the infrastructure base. So you get more congestion in infrastructure, you've got to share it with more people. In the case of housing, obviously, we've got record, rental vacancy rates at record low. We've brought more people in than we can build houses for, and that's created a rental crisis. And a general hit to our livability, because if you live in Sydney, Melbourne, on the big major cities, you're watching everything's become crush loaded. Whether that's to go to a hospital, go to a doctor, or whatever, everything takes longer now, and everything's more congested than it was before. And this is all hits to your quality of life, and it's just going to get worse, because unfortunately, the federal budget, not the federal budget, the Centre for Population in their 40-year population forecast for Australia forecast they're going to add another 13 plus million people in the next 40 years. And we're going to effectively add another Sydney, Melbourne, and Perth to the nation's population in just 40 years. And nearly 11 million of that is going to be in the capital cities. And Sydney's going to go to according to their forecast, Sydney's going to be 8.5 million people by the mid-2060s. Melbourne's going to be 9.2 million people. I think Brisbane's going to be, 4.8. Might be 4 point something, like 4 point middle fours, and Perth similar. So basically, we're going to have two mega cities of Melbourne and Sydney, and Sydney's supposed to grow by nearly 3 million people by the over the next 40 years. Melbourne's supposed to grow by about 4 million people, or not quite, but close. And you just got to ask yourself, how are we going to squeeze this number of people in without seriously compromising living standards? How are we going to build enough infrastructure for these millions of extra people especially the two major cities? Where's the water going to come from? We're going to have to build desalination plants everywhere. Where's the energy going to come from? Are our grandchildren going to have to live in shoebox apartments because houses will become so scarce and so expensive and so rare, because we're going to have literally in Sydney 3 million more people in the existing urban footprint? Which means we're going to have to bulldoze a whole bunch of houses and build apartments instead. Similar in Melbourne. So, these are all the questions that the government never bothers to look at. And the Federal Treasury certainly never looks at it, because the Federal Treasury is too busy counting the dollars. So we have one of the worst vertical fiscal imbalances in the world in this country, whereby the federal government collects 80% of the tax revenue and the states and local governments only collect about 20%. And as a result, the federal government, which controls migration policy, has a direct incentive to import hundreds of thousands of people every year, because if they do that, they get to collect all the extra personal income taxes, which is the main thing they collect, as well as the extra company taxes and other things that the federal government collects. But they don't pay the costs. So the costs of that migration aren't internalised on the federal government. So we're talking about, most of the costs from migration get pushed onto the state governments, because the state governments are primarily responsible for the services and infrastructure, be that schools, hospitals, public transport, those sorts of things. And in order to, those things have to keep up with the population, otherwise your living standards go down. And the federal government basically force feeds people into Sydney and Melbourne, as well as Brisbane and Perth as well. But and the state governments are left trying to build the infrastructure and services for these people. They can never afford to do it, so they end up going into debt, which is why places like Victoria and New South Wales are drowning in debt. And often those governments will then sell off every single private asset they can to get some quick money in the door. They go down to the cash converters and flog off the titles registry and all the utilities and everything they can sell to try and get some money in the door, so they can then try and build some infrastructure, which they then end up selling off to Transurban, whatever anyway. And we ultimately end up with lower living standards. And this is all because we have this ridiculous system whereby the federal government gets all the gains from immigration, doesn't wear the costs, so continues to run it hot. It's as simple as that.
Absolutely. And, this is a complex set of interactions between multiple dimensions, right? And I think sometimes people want to see simple, logic, one-to-one logic. And this question came in as you were talking, which is, how can house prices fall if you say migration is going up? Well, my thoughts, and then I'll let Leith build up from that. One is when migrants come, the first thing they tend to do is to come into Australia and then rent. So it puts initial pressure on the rental sector first, and we're already seeing that. Some of them come with sufficient funds to be able to potentially buy later, but a lot of them are not actually that high quality migrants. So their income base and their asset base is not that flash. So many of them don't end up necessarily going directly into the housing market early on, or they go into a model of housing where you've got multiple occupancy in one property. So there's some factors there. But Leith, how can house prices fall when migration is going up?
Well, yeah, I mean, I think you explained it well. So house prices, like migration is just one of many inputs into the house price model, if you wanted to call it a model. Interest rates is obviously a major one, borrowing capacity, like lending rules, all those sorts of things, tax settings. There's a whole bunch of, there's a whole range of things that go in and set house prices. Migration is just one small component of that. And so it's multifaceted, but the house prices, the drivers of house prices are multifaceted. And that's because you borrow for housing, like to purchase a home typically involves borrowing, involves leverage, involves going to a bank. And so all these lending rules and that sort of thing matter. Whereas rents, you can't leverage rents, right? You can't borrow to pay rents. Rents are based on more of a pure supply demand market. Number of people who need rentals versus the number of rentals in the market. They're the two main factors, and obviously income growth as well, right? So it's a three variable market really, renting. It's demand, supply, as well as household income growth determines how much people can pay on rents. Whereas for house prices, it's those things, but also lending rules, interest rates, tax policies, all these sorts of things, bank and mum and dad, all these factors that influence house prices. And unfortunately, even with high migration, a lot of these factors that determine house prices are pointed down, right? They're basically negatives at the moment. So we've got rising interest rates, negative. With rising interest rates, you get lower borrowing capacity. That's a negative. We've just had the federal budget change capital gains tax and negative gearing, which is going to smack investor demand. That's a negative. Lenders are now going to lend less money to investors because they can't take into consideration the added cash flow given the after-tax cash flow from negative gearing. That's a negative, right? Obviously, just general overvaluations are negative. Economic conditions, we're likely to get rising unemployment, etc. That's also negative. So there's a whole bunch of negative factors that are likely to push down house prices, even though immigration is one small positive. But again, when you talk about what the factors that set house prices, I'd say if you had to weight them, immigration is probably like 15% on its impact. If you had to do a house price model of what determines house prices, immigration, well, the rate of immigration is probably like 15% of that variable. But on the rental side, it's the dominant variable. And because it's more of a just pure supply demand market, because the whole credit factors and capacity to borrow and all that sort of stuff don't register on the rental side.
Absolutely. I did some modeling some years ago looking at those different levers and their ability to be able to influence the property market. The biggest by far was credit availability. So if you increase the multiples at which you can borrow, or if you drop the interest rates, which means you can borrow more because borrowing capacity actually is a function of interest rates, then effectively that's going to put a lot of upward pressure and momentum on prices. The reverse is true. If interest rates go up, all else being equal, the borrowing capacity comes down, and that means that people are less able to borrow. Of course, the banks have actually been quite clever in recent times because they've tended to grow the average loan duration out, which reduces the interest payments a little.
Yep.
And they're still pushing interest-only loans on quite a few households. In some cases, I think a bit irresponsibly, because interest only doesn't solve the capital problem. And if you don't have capital appreciation, you've still got a problem because you've still got a debt that you're not actually servicing. So I think those are some of the factors to bear in mind. Migration is a critical issue, but it's not the only issue. And so when Angus Taylor, for example, links migration to housing numbers, I think that math is a bit too simplistic.
Yeah, yeah. I mean, look, certainly, I think it's fair enough if you're talking about the rental side. If he's trying to talk about making house prices affordable,
Mm.
yeah, look, that's way too simplistic. But if he's talking, if because I must admit, I'd actually read what he said about it because I think because he's so unlikely to win, I haven't really paid that much attention to it. But if he's talking about general housing affordability, he's probably on a winner if he's talking about the rental affordability.
Yeah.
And you know, to be honest with you, when I talk about housing affordability these days, I sort of focus more on the rental side anyway, because I think I've said this previously on this show. You don't have to buy a home, but you have to live somewhere. So if you can't buy one, you still have to rent, right? Um, so rental, you know, renting is the fallback option. It tends to hit lower income earners harder as well because lower income earners tend to rent. If you're a first home buyer, you typically rent before you buy later. So you know, for me, when I talk about housing affordability, I nowadays I focus on the rental market because you know, not everyone has to buy a home, even though, you know, that's almost, I don't want to sound up myself or anything, but that's almost a luxury now, is buying a home. But everyone needs somewhere to live. So if you can't buy a home, you've got to rent. And if we make that expensive, well, then the next step after you not being able to afford rent is effectively homelessness, right? You know, the next rung below that is living in a caravan park. The next rung below that is living in a car. And then next rung below that is literally being out in the street. So if we make the rental side particularly unaffordable, that has major social ramifications, right? So that's the sort of issue that I look at more. And there's no doubt about it that we've run migration so hot, so much faster than the capacity to be able to supply housing, that we're just making that rental crisis, that rental equation really bad. And if you just look, again, if you look at the totality numbers, they reckon that advertised rents have increased by 50% now since the end of 2019, and that's added more than $11,000 per year to the annual cost of renting the median home, according to Cotality. So that is just a massive hit to anybody's a tenant in Australia. You're now sacrificing a much larger share of your income just to put a roof over your head renting than you were, several years ago, and that's a pretty poor situation.
Yeah, and of course, if you think about real adjusted incomes that haven't really grown much at all for a good number of years, it means a greater proportion of that income has to go on the rent. And I'm seeing a lot of households now at 45, 50, 55% of their disposable income just going to pay the rent, which doesn't give a lot left for other things. So that's another factor in all of this, and that's why we've got a lot of households in significant difficulty. Now, let's just switch to the budget a little bit, because it's worth, I think, just unpicking the nexus between the budget and housing a bit more, because there were some significant changes.
Yeah, yeah, absolutely. So obviously there was some stuff that was flagged beforehand, right? So we knew before budget night, a couple of days before, it was pretty well leaked that they were going to basically abolish negative gearing on existing housing. So how that works is if you had a investment property before budget night, so last Tuesday, you could continue to negative gear that forever, so that until you sell it. So that's basically been grandfathered. If you purchase a home between budget night and 1 July next year, you can negative gear for the next financial year about to start. But after 1 July next year, basically anybody who didn't have an investment home before budget night will no longer be able to negatively gear. So what that means is that any net rental loss on their property, they won't be able to apply that against their ordinary wage and salary earnings. They'll have to carry it forward, either for future years whereby if they hold the property long enough, it eventually becomes positively geared, meaning the rents grow enough to more than offset the outgoings. You can then apply those accumulated losses against that. Or if you eventually sell the home, you can apply that against your capital gains to reduce your capital gains tax. So you basically you can't claim those losses against your current income. You've got to carry it forward. There was also an exemption for newly constructed dwellings. So the government basically is going to allow negative gearing going forward if you buy a newly constructed dwelling. So that's either you develop one yourself or you purchase a brand new one. You will then be able to negatively gear. And the policy intent to that is obviously to push investor demand into newly constructed dwellings to try and boost housing supply. The capital gains tax changes were also well flagged, although there was one hand grenade in there, which I'll mention in a second. So basically for 1 July next year, we're going to shift back to the pre-1999 dividend, the CGT indexation model. So what that means is that before budget night last week, or actually up until 1 July next year, you can basically, it's the old 50% CGT discount method. So what that means is that if you buy an asset for, I don't know, I'm just going to pick this out of the air, $500,000, and you then sell it years later for $1 million, and you make a $500,000 nominal profit, so that's before inflation, you then pay half your marginal tax rate on that gain, right? So it was basically 50. So what it meant is that the maximum capital gain that you could pay was, I think, 22.5%. So the top marginal tax rate divided by 2. And from 1 July next year, we're going to basically the old model, which is dividend indexation. So what that means is that you get taxed at your full marginal tax rate, but only on the real gain of that. So the nominal gain less the inflation rate. So again, using that example, if you buy a house for $500,000, you sell it for $1 million 10 years later, but over that time, inflation was 50. So if inflation was half of your gain, you only pay tax on the gain less the accumulated inflation over that time. I hope I explained that properly. So that sort of model is less advantageous if you're in a fast-moving market. So if you buy an asset at the start of an upswing and it gains value very quickly and you want to sell it, after a couple of years, you're obviously worse off with the inflation indexation model because you won't have that much inflation build up over that period of time, but you'll be paying on a higher real gain. But the longer you hold the asset, so if you hold the asset, say, for 20 years and you accumulate years and years and years of inflation over that time, it actually becomes more advantageous the longer you hold it. And under this indexation model than the old model. But by and large, it's a net negative for most investors. They'll end up paying more tax. And there was a hand grenade in there whereby the government's implemented a 30% minimum tax on capital gains. Now, that was clearly designed, I think it's a bit scummy, to be quite honest. That was clearly designed to have a go at self-funded retirees, right? So what they want to do is they basically want to get more tax out of people who accumulate assets over the working life, shift into retirement, quit work, so they're not having that, so they don't have earned income. And then if they sell off, say, parcels of shares to help fund their retirement, the government wants to charge them a 30% tax rate on their real inflation-adjusted gains. Now, just to give you an example, so if you're a self-funded retiree, you move into retirement, you want to sell off $15,000 of shares every year to help fund your retirement, just to give you a bit of a supplement. Say you're getting a bit of super money as well. Without this minimum 30% tax rate, you'll pay 0% tax on that capital gain because you'll be below the tax-free threshold. If you sold, say, $40,000 parcel worth of shares, you'd pay a 16% tax rate without this minimum 30% tax because you're below the $45,000 threshold whereby the market tax rate goes up to 30%. What the government basically wants to do is set a minimum 30% tax rate to try and extract more tax out of those people. I think it's a bit scummy, but whatever. By and large, my overall take on the on these changes for the property market is actually pretty good. Like I personally have no issue with the negative gearing and the capital gains tax changes for established dwelling. I think it's a good thing. And the reason why I think it's a good thing is that chart on the right, which I've got here, which basically shows you, so this is from Domain, but it shows you the correlation between investor mortgage demand and first home buyer mortgage demand. You can see that they're almost a mirror image of each other. So when investor mortgage demand goes up, first home buyer mortgage demand goes down. And that just tells you that investors are crowding out first home buyers from home ownership because they tend to compete for the similar stock, right? So often you'll go to a first home buyer will go to an auction. This is before these rules came in. And they get outbidded by an investor, and which means that they're forced to rent rather than own a property, right? Which is obviously not good socially. If you can knock out some of that investor demand especially out of the established market, it means that you'll have downward pressure on house prices because you're going to have less overall demand less overall mortgage demand for housing. That's good. It's going to make housing at the margin more affordable. You're also going to have more first home buyer participation, obviously, because you're going to have less investors buying, which means you're going to have more first home buyers. That's good. And also means that over time, you're going to have a higher home ownership rate because you're going to have more first home buyers in the market and less investors. That's a good thing. So this is all good stuff, right? Now, the property lobby is obviously squealing that these changes are going to kill the rental market and basically drive up rents because they reckon, oh, well, if investors don't participate and they leave the market, therefore you're going to have less rental homes. Well, that's actually not true, and it's not actually a particularly smart argument because obviously if an investor sells a home, right, an established home, the home doesn't disappear. It'll get sold to an owner-occupier. And what it means is that you basically substitute a home for rent, you make it into a home, an owner-occupier home. So it means that a first home buyer, instead of being a renter, they become a first home buyer. So yes, you reduce the supply of rental properties, but you also reduce the demand for rental properties because you have more owner-occupiers in the market who don't need rentals. So, and to be honest with you, I've got some charts here. Now, maybe the situation's changed from what it was back then, but I have some charts here, and I did these years ago, back when Labor in 2019 was looking to, implement to abolish negative gearing and change capital gains taxes, and there was all those arguments about, it's going to drive up rents, and when the Keating government temporarily abolished negative gearing between 1985 and 1987, it sent rents soaring, blah blah blah. It's not true. So I've got some charts here. Again, I did these years ago of real inflation-adjusted rents. And you can see the capital city aggregate on the left-hand side. I've put in the red is the period that negative gearing was abolished. And you can see that it had absolutely no impact on the rental market in aggregate. That's the chart on the left. Now, there were two markets where rents did rise over that period, and that was Sydney and Perth. And I'm doing real rents here, so inflation-adjusted. Sydney and Perth rents did rise, and that was because the rental vacancy rates in those two markets were incredibly low when the rules came in. So the market was rising anyway. But the other markets, the rental growth actually fell or was negative. So Melbourne, the real rental growth actually fell when the negative gearing reforms came in. Brisbane rents actually fell in real terms. Same in Adelaide. Hobart, no discernible change. Canberra, the real rents actually, the rental growth fell. So it's all pretty obvious. It's all shown there in red. I'm not the only one to come up with these conclusions. Sol Lestlake came up with exactly the same conclusions. That's the panel on the left. ABC Fact Check came up with the same conclusions, and so did the Grattan Institute. So basically, it's a bit of a myth that the abolishment of negative gearing back in the 80s actually drove up rents. And just one final point, we actually sort of know how this is going to work out a little bit in the rental market just by looking at Melbourne or Victoria, because although it's different, Victoria several years ago massively increased land taxes for investors. And what they did was it actually reduced the number of investors in Victoria. So a whole bunch of property investors have sold up in Victoria, and they've sold their rental properties. And you can see the chart on the left-hand side, which actually comes from the Victorian government. You can see that the number of active rental bonds in Victoria, so that's basically a proxy for rental supply in the state, has actually shrunk. So investors have been selling up for a long time now, many months, many quarters in Victoria, yet Victoria's actually experienced slower rental growth than the other capital cities, according to Cotality. And Victoria's rental affordability, Melbourne, I should say, Melbourne has experienced slower rental growth than the other capitals. It's also has better rental affordability than the other capitals. Now, this doesn't say that these changes make rents more affordable. This is more a story on migration. So Victoria and Melbourne's population growth hasn't grown as quickly as its pre-pandemic trend because so many people left Melbourne during the pandemic. So Victoria's actually had slower population growth than it had pre-pandemic, whereas places like Queensland have had much stronger growth, South Australia's had much stronger growth, Western Australia's had strong growth, and New South Wales has had roughly the same. It's basically followed its pre-pandemic trend. So it's more a population growth story. But even so, if it was true that these sorts of disincentives for investors that actually lead investors to sell properties drove up rents. Well, surely you would have seen it in Victoria and Melbourne when the government brought in these land tax changes. Because again, as that chart shows very clearly on the left, the green bars, heaps of investors have left the Victorian market, and yet rents haven't exploded in Victoria. Right, so I'm personally not concerned about the impact on the rental market from these changes. If I am concerned about the rental market in general, but that's more an immigration story. And again, rents have risen by 50% according to Cotality since the end of 2019, with negative gearing and with full capital gains, like the old capital gains tax rules, right? So I don't think all of a sudden, now that these rules have come in, that the rents are going to suddenly soar when they've already soared anyway over the last couple of years. And they certainly will rise, but they're not going to rise because of these changes. They're going to rise because the government continues to pump immigration like there's no tomorrow into a market that can't build enough homes, as I've explained previously. And I think that's the fundamental driver of rents. It's not these sorts of changes.
Absolutely. I agree with you, Leith. And I've held the same view as you for some time, that the migration question and the rental question is intrinsically linked. And, there are examples around the world. We've covered that in previous shows, in New Zealand and Canada, right, where in fact rents have corrected a little bit more. But just on the budget, it's very interesting to just unpick some of the assumptions that were in the budget papers. Now, there are always assumptions in any budget, but I thought there were some really quite interesting ones here. No change in productivity over the forward view. So productivity is still going to be sluggish, despite the fact that they promised that they were going to cut some red tape. I will believe that when we see it. The share of the economy that is actually effectively funded by government going up, not down, and the share of tax take from individuals continuing to rise relative to corporates, absolutely there. But they also had two different scenarios, didn't they, about the impact of the oil situation. And it's worth just reflecting on the fact that the budget core assumption is it's a short-term blip in oil price and it comes back quickly. But they did have another view as well, which was actually much more adverse.
Yeah, absolutely. So they also forecast, I think they call it the prolonged war. And it was basically, it's sort of an edge case that they've come up with, where they reckon the Brent crude price, instead of, falling back quickly, which is kind of their baseline forecast at the moment, is that the whole thing gets resolved and we get oil prices coming back down, et cetera, which I think that's a little bit too optimistic. But they also did an edge case whereby Brent crude goes up to $200 US per barrel, which is basically sort of double the current level. So, a massive oil shock. And I think the highest in history is about 150-ish, or not even 150, just under. So, we're talking very expensive prices. And that would basically drive inflation above 7%, push unemployment above 5%. It would also shave about, I think, 0.5% annually off growth. So, that's their, mega cataclysmic scenario in the budget. Now, I personally think we'll probably be somewhere between what they've forecast and that. I think that's probably an edge case that they've, that's their doomsday scenario. I don't think we probably won't get that, but I think also the way things are going in the Middle East, I don't think we're going to get a quick resolution either. So, we'll probably get something in between what the baseline forecast was and that. Whether it's more towards what they're predicting or more the other way, I don't know. Like, how long's a piece of string? But I think it's going to be sort of somewhere in between.
Yeah, and it's interesting to note they use the 60 US iron ore price as a bit of a hollow log, which they always do, and then magically manage to exceed the budget, which is another.
I actually don't mind that though. I sort of don't mind that they're cautious on that. I think I'd rather that than sort of being, forecasting $100 plus whatever, and then look, we've got budget surpluses and all this stuff, because then they go, we've got all these surpluses, let's go and spend it.
Yeah, well, I sort of agree, but then they claim magic.
Oh, good, yeah.
Yeah, good.
They always spin it.
Good management of the budget. No, you were just wrong on your forecast again, which, and I agree, it's good being conservative. Now, I just want to touch a bit further on this tax take issue, because I don't think people have got their head around the implications of all of this.
Yeah, so, this is one of my biggest issues with the budget, right? So they've worked out all these ways to get more tax. So closing down obviously negative gearing changes is going to raise more tax. The capital gains tax changes, they forecast to raise more tax. They've also implemented a 30% tax on discretionary trusts, which again, I don't actually disagree with it. I'm not an expert in how discretionary trusts are used, but I imagine they're used for tax avoidance. So, if you're reducing the ability for people to avoid tax, well, as someone who doesn't use one of those trusts, I'm all for it because I don't do it. I don't use it, right? So, but the thing about it is I'm all for that stuff if they were then to use that buckets of extra billions of dollars that they've raised to then lower the burden on income, on regular wage and salary earners, because the federal budget is one of the most addicted. The federal government in Australia is one of the most addicted governments in the world to personal income taxes. So, according to the budget papers, 52% of the federal government's revenue, the federal budget's revenue, comes from personal income taxes, which is just absurdly high. And over the by I think it's 2030, according to the budget, it's by 2029-30, the forecast that the tax take from personal income taxes is going to go from 52% currently to 54.5% of federal revenue. So they're going to increase their tax take. Now, the thing about it is the average tax take from the federal government, I've got a chart here, which is, it's more personal tax revenue to GDP. But you can see that it's gone up quite a lot already, especially over the last several years. And it's forecast by the Parliamentary Budget Office just to keep rising. Now, the reason why that's scummy is that, especially in the recent years, real wages in Australia have actually fallen by about 6% since mid 2020. So in this post-COVID period, the typical Australian has less purchasing power than they had before because their wages haven't kept up with inflation. Yet, despite that, we're all paying higher taxes than we were 5 years ago, because every single year that we get this nominal wage growth that doesn't keep up with inflation, the federal government takes a higher share of our income as tax because we move up into higher tax brackets, right? So every year, by doing nothing at all, the federal government collects more tax revenue from us, even though we're going backwards with negative real wage growth. And that's obviously something, that's not particularly fair because the federal government indexes lots of taxes that we pay. So, for example, all the excises, so tobacco, fuel, alcohol, all those sorts of excises and some other taxes are indexed every year by inflation. So the reason why they do that is to ensure that their tax take doesn't shrink in real terms. But they don't then index the tax scales by I don't necessarily think they should do it by inflation, but they should do it by the midpoint of the RBA's target band, so 2.5%. They don't index the tax scales to ensure that we're not dragged into higher tax brackets every year purely because of inflation, right? So it's a sort of heads I win, tails you lose scenario. Now, the reason why it matters is that Australia's tax system is becoming absolutely ludicrous. So according to the Australian Bureau of Statistics, and I pulled these numbers last week, as of May last year, so May 2025, the median full-time cash earnings in Australia, so cash earnings are basically all your earnings you get before tax from working in a job. They were $98,124. That was in May last year. Now, if you uplift that by the wage growth we've just had, it means that currently the median full-time earnings in Australia are about $101,000. Right? That's as of May this year. Now, the data hasn't come out yet from the ABS because it always comes out late, but you can sort of, be around $100,000 or just over. That means that you only have to earn about 1.9 times the median full-time earnings. So not the average, the median. The average is higher again to pay the top marginal tax rate in Australia. Now, I think that's absurd that it kicks in at such a low rate. And according to, if you actually, upscale the current median full-time earnings by the wage growth forecast in the budget, means that by 2027-28, the median full-time wage is going to be about $108,500. And that means that by 2027-28, if the government doesn't change the tax scales, you only have to earn 1.75 times the median full-time earnings to pay the top marginal tax rate. And what I've done is, at the bottom there, I've done a table where I've basically just extrapolated by the budget's sort of steady state wage growth forecasts over the next decade. And if we just got 3.25% wage growth every year, which isn't even a lot, And in this sort of higher inflationary environment we've got, and we're probably going to have a prolonged period of sort of stagflation a little bit. We're going to have median full-time earnings that barely keep up with inflation, but we're going to get pushed into higher and higher tax brackets. And just as an example, so I've just used the top marginal tax rate here as an example. If they don't adjust the scales by 2035, 36, so in a decade's time, if you just upscale the median full-time earnings by wage growth, by then we're going to have a median full-time earnings of $140,000. And you only have to earn just under 1.4 times the median to pay the top marginal tax rate. So this is just an absurd situation we've got here, whereby by doing nothing at all, the government every year is collecting more tax off us, even though our incomes in the last several years haven't kept up with inflation. And in fact, the RBA's forecast in the Statement of Monetary Policy forecast that by 2027, 28, which is as far out as they go, real wages in Australia are going to be tracking at about December 2011 levels. It might be to December 2012. But regardless, we're going to be tracking at levels we haven't seen for decades because our purchasing power has been eroded by inflation so much. And yet we're going to be paying more taxes than ever because every single year we get dragged into these higher tax brackets by nominal wage growth that doesn't keep up with inflation. Basically, we're getting dragged in higher tax brackets because of inflation. So this, Martin, is my biggest single issue with the budget, is that the government, it's a tax grab, not tax reform, because they've worked out all these different ways to squeeze extra tax out of us by negative gearing, capital gains taxes, taxing discretionary trusts. Some of that stuff's good, but it's not good when they don't then use that money to reduce the burden on wage and salary earners. And this is another reason why this whole argument about intergenerational equity was complete crap. Because if you want to make the situation more equitable for younger people, don't tax them so bloody hard. Because it's young people who are entering the workforce or are entering their peak earning years now who are trying to get in the housing market, but you're taxing them more and more every year, which makes it harder for them to not just buy a house, but harder for them to live. And the federal, our tax system is so warped that the government thinks it's okay to spend billions and billions of dollars subsidising the purchase of electric vehicles so that when someone buys an electric vehicle, they then don't pay fuel excise. So the government pays money out of the budget to subsidise people to buy an electric vehicle, and then they lose the revenue from the fuel excise, which then they make up through gouging wage and salary earners with extra income taxes every year. So, this is another thing that annoyed me about this budget. They kept going on about intergenerational equity and stuff. It's like, well, how's this helping intergenerational equity by charging wage and salary earners more every year when it's young people who have got 40 years of work ahead of them or 30 to 40 years ahead of them are going to get absolutely gouged for extra tax every year? Like, if you want to help them, cut their bloody income taxes, right? And raise tax elsewhere. So whether that be from raising the GST or, I don't know, taxing our resources better, or or even better, stop spending so much bloody money. Because the federal government is, let's face it, they're not spending our money very well. And one of the things I hate about this income tax system we've got that continually showers the government with more money every year just through bracket creep is that it gives the government no incentive to cut back spending and actually spend our money wisely. Because every year, the pot of money that they collect off us rises because of bracket creep, and that gives them more money to waste, right? And so if we actually index the tax scales, it would give the government less money to waste every year, and they might actually have to spend it a little bit better. So, this whole thing about intergenerational equity, what a load of hogwash. Right? Yes, they did some tinkering around negative gearing and capital gains taxes, which will take some demand, pressure off house prices, will slightly boost the home ownership rate and first home buyer share. That's good. But at the same time, you're gouging young people with higher income taxes. The government's spending like drunken sailors, which they have been. And as a result, we've got higher state and federal debt, which means that if you're a young person now entering the workforce, you're now, entering an economy with much higher per capita public debt than someone 20 years ago did. So that's not equitable. And at the same time, the government's running a mass migration program, which is driving up the cost of renting which hurts young people who are in the rental market, and first home buyers who want to purchase a home who then have to spend more on rents because of high migration, which means that they take longer to save up a deposit. And also, obviously, the high migration puts some upward pressure on prices as well. So, this whole thing about intergenerational equity was complete crap, to be quite honest. There was only, one tiny policy in that budget which actually helps young people looking to buy a home at the same time as the government's gouging them in all these other ways. And, of course, that's been ignored by most of the media.
Absolutely. And just a couple of other interesting points. If you look at that ratio, the 1 point, whatever it was that you showed, in some European countries, it's 5 times. So in other countries, the profile of when highest tax rates come in are completely different.
Yeah, can I just add to that? Just, so pretty much the only countries that are sort of similar to us are the Scandinavian countries.
Yep.
So those ones have similar ratios, but pretty much like all the other English-speaking countries have got much higher ratios than us. New Zealand's, by memory, was about 2.5. So it's not that much better, but slightly better. But, UK is a lot better. Canada's higher. US is higher, like significantly higher. We're more like a Scandinavian country in the way we charge for personal income taxes, but without the Scandinavian country benefits.
Yes, I was going to say that if you compare the Scandinavian countries with very significant profiles like we've seen, they have a huge amount of more support for people through their more sort of a social model. The other observation is if you think of the full year that you work for, I reckon it's about May before you actually start earning for yourself. Yeah. So, up till May, you are basically just earning for the government. And that's a problem because that has now moved. It used to be, I think, April, and now it's moved to May. So more of the year, you are just effectively, whatever you're doing, wherever you're working, you're basically working for the government.
Yeah, and we haven't even talked about that, but there's another issue with the budget which I'm concerned about, which I'm hoping they fix. Like there has been some mutterings that they're going to reconsider this, but the obviously the capital gains tax changes also they do risk stifling startups and venture capital. So and I know this from my own experience, although I wouldn't fall into these rules, but if you're someone who basically quits, like for me in my case, I quit Goldman Sachs, right, and started Macrobusiness, took a monstrous pay cut. Like I think 2/3 pay cut, maybe 3/4. I basically lived on baked beans for a couple of years. Incredibly stressful. Never worked as hard in my life trying to start that up. But that there is less incentive to try and start something new when at the end of that period, when if you succeed, and there's a lot of companies, a lot of startups don't succeed. Like the chance of succeeding is actually pretty low. There's going to be less incentive to actually do a startup. If at the end of that, if you succeed, and you sell it, you then got to pay higher capital gains taxes. And it's particularly bad for startups because often when you start a startup, now I wasn't in this boat because we were just, myself, Dave, and another guy started up and we didn't have employees, right? So this doesn't apply to us. But a lot of startups, they have to employ people and they can't afford to pay them full salary. So what they do is they give them equity in the company, right? So you take a reduced salary for equity in the company. But that equity becomes less enticing if you're going to pay higher capital gains tax on that in the event that it's actually successful. And most of these startups start with a business valuation of 0, right? Which means that pretty much any value you get at the end is going to be taxed on the full amount because you're starting off with 0, right? So there is a risk, and this has been a massive concern in the venture capital community as well as the startup community, the tech sector, all this sort of stuff. They've all been very concerned that these capital gains tax changes are going to give less incentive for people to basically go out on a limb, have a go, and try and start something up. And that ultimately is bad for the nation's productivity. It's going to be bad for business investment at a time when Australia's business investment is incredibly low and it needs to increase. And it's ultimately going to stifle entrepreneurship and potentially send capital overseas and also potentially send people overseas. Like, entrepreneurs will be incentivized to leave Australia and have a go somewhere else. Because we will, after these after these changes, have capital gains taxes that are among the very, very highest in the world. Now, there was one positive in the budget fact sheet on the capital gains tax changes. They did have one paragraph that suggested that the government is going to consult with the startup sector on the impacts of the capital gains tax changes. Treasurer Jim Chalmers has been out the last few days saying that they're looking into it and they're going to consult with the industry. So is Claire O'Neill. She's mentioned that as well in the media. So hopefully the government's going to carve startups out of the new capital gains tax rules, because really my personal view is if you're going to try and start something new and you're going to risk failure, which a lot of them do, they should be taxed at a lower rate, right? We should be trying to encourage people to have a go and to try and create new things, because by doing that, you end up with the Atlassians or Canva and these other successful companies, as well as a whole bunch of medium-sized countries that medium-sized companies that none of us have ever heard of, which are successful, right? There's heaps of those across Australia, but most of them started off as valued at zero with as an idea and worked really hard for multiple years and then got to where they are. But along with those success stories, there's also probably 3 times as many that fail, and the government doesn't give you a subsidy if you fail, but they expect to take a big chunk if you win, right? If you win and sell, they take a massive amount of your money, but if you fail, they don't give you a subsidy for it, right? They don't bail you out if you fail. So it's a sort of heads I win, tails you lose scenario from the government. So I'd like to see the government actually walk back the capital gains tax changes and actually tax startups pretty lightly, because we actually need more people to have a go in Australia. We need more entrepreneurship and we need more new businesses created, because ultimately that's going to lift all boats. It's going to increase productivity. It's going to increase investment. That's the sort of stuff Australia should be going for, rather than trying to tax it out of existence, which unfortunately I think could be one of the the side effects.
Yeah, and I'd add to that, the cost of energy, of course, is also another huge impost on businesses trying to get going, and a lot of manufacturing has gone offshore because of it. So if you look at the tax settings that we've now got, as well as those energy costs, it's really, really hard to see how businesses can thrive. And I agree with you that startup situation should absolutely be revised. And there are probably some other negotiations that will probably go on in terms of the budget process. But the bottom line for me is that if you stand back and just think about all the things we've been talking about today, the chances are we're going to see property prices sliding. We're going to see momentum in new construction not taking off the way the government wants. They're not going to be able to achieve their targets. We're going to see households who are more taxed and effectively getting less for that tax take, because the government is horribly inefficient in terms of how and where it spends its money. And it quite often spends things, the tobacco excise story being a magic example of how not to do things, for example. And
Snowy hydro.
Snowy hydro, another one. Oh, and I should just say it's 119 billion that's off balance sheet, which is other little number, right? Snowy hydro 100%. And a few other things completely out of the numbers. So they've actually continued to use that wonderful little technique of hiding those big expenditures.
Slush funds everywhere. And so when you stand back and just think about it, you've got to ask, well, who is the government working for then? Yeah, that's right. So it's obviously working for its own self-interest, that you think, or the big end of town, or there's certainly certain groups that are on the take who are obviously doing very nicely out of this, whether it's the CFMEU in Victoria and a whole bunch of others. So or unions in the industry super space or whatever. They're certainly not working in our benefit, which is the reason why this stuff matters is because the federal budget makes up about 1/4 of the nation's spending, right? So it's a massive part of the economy. And obviously that 1/4 of spending is predominantly through taxes, right? The rest of it's borrowing, which is not a good thing. But so they basically tax households and businesses a bootload of money to then recycle that spending into all these different areas. Some of it's good, but some of it's bad and some of it's wasteful. Right. So we should care about how that's spent, because it's basically 1/4 of the economy. It's 1/4 of domestic demand, roughly. And if you had the states, it's more like 40%. Right. So, because the states are a whole nother story. They're also basket case as well. I live in Victoria. I'm living it. Right. So, this is all really important stuff. And it's important because it's our money and we should care how that's spent and how efficiently it's spent. And also, we should care that the government is basically working at cross purposes to the Reserve Bank of Australia. So, even before this energy shock began, or the war, in the Middle East began in late February, we had inflation well above target. We had excessive government spending. The RBA had just lifted rates once in February before the war even started. So we already had an inflation problem. And we had an inflation problem predominantly because the government's basically engaging in wartime spending levels, right? We've basically got the highest public spending share to GDP. It's slightly below the peak of the pandemic, but it's basically at sort of wartime levels. If you'd have to go back to the Second World War to get similar sort of spending levels that we've got now. So the government's running sort of an expansionary wartime budget during peace times. To borrow Tarek's phrase, we've got a burnout economy, whereby the federal government's got the demand, it's got the foot on the pedal, pumping the gas through its massive spending, while the RBA's got its foot jammed on the brake, trying to hike interest rates to slow demand, and the government's working at cross purposes to the RBA. And ideally, you'd have a situation where the government spends our money properly because it's our money, but also doesn't work at cross purposes to the RBA. And unfortunately, they're doing both. They're spending poorly, and they're working at cross purposes to the RBA. They've got the foot on the gas while the RBA is trying to, slow the economy and slow inflation. And then, unfortunately, obviously this global energy shock's reared its ugly head. Now we've got cost push inflation from that. So we've just got this absolute perfect inflation storm at the moment. And it was already a problem before the war, but now the war's hit. We've had the feed-in directly from the higher petrol, diesel prices. And now we're getting the second round impacts of that, whereby businesses are now passing on the extra fuel costs in what they charge. So now we're getting the second round inflation impacts as well. So, this is all a disturbing situation, but, the RBA can't really do anything about the global energy shock, but the government sure as hell can help them out by spending properly, wisely, and not spending like drunken sailors, which unfortunately is what they're doing.
Absolutely. And spinning remarkably as well, trying to dress it up as intergenerational fairness and support for the housing sector, all of those things. There's a little bit of that in there, but it's not really the main objective. And I think that when we look back on this budget, Leith, I think we will say that there was a potential to do a lot more good than they actually did do, although within it there were a couple of changes that were actually quite beneficial, I think, in terms of the CGT and negative gearing for the housing sector. But more broadly, because of this global shock that is coming down the pipes, the clocks are ticking, we're going to run out of various things at various points, no easy way out there. The RBA, in their minutes, said they're going to probably have to sort of wait and see how things shake out, but the market is saying more rate hikes. So another downward force on property.
Yeah, can I just add to that? So that was interesting. So the RBA minutes came out today, and also Sarah Hunter, who's the assistant governor, she gave a speech as well. So we had sort of two tidbits there, and yeah, they basically said they're going to, the board's leaning towards holding in June, so we're probably not going to get a rate hike in the next meeting because I want to see how things sort of pan out. But in Sarah Hunter's speech, she basically said that they are expecting, significant second round inflation impacts. So we've already had the initial hit from as I said, the rising petrol, diesel prices, etc. And now the RBA is expecting, quite a lot of pass through from broader businesses into costs. So I mentioned before the cost of construction materials are already sort of fed in. They're now expecting broader cost pressures. And I've got a chart here actually from today's speech from Sarah Hunter. It's the chart on the far right. So indirect domestic fuel intensity of CPI. And this is a chart she put up in her speech. And it basically shows you how much we're expecting, how much all these different components could be impacted indirectly by high fuel prices. So obviously travel is more expensive, right? So if you want to get on a plane, use avgas, that's gone up in price. But also fruit and vegetables has a very high diesel component. Groceries, very high diesel component, because pretty much everything in a shop, when you go and buy something in a shop, everything is got there via a diesel powered, truck or via a ship on bunker fuel, so it's basically been delivered via a diesel powered or a bunker fuel powered, device or vehicle. But you can see in those yellow bars there how much higher diesel prices impact all these areas. And I've got a chart there in the far left also, which shows that Australia is the most diesel dependent economy in the world, just about, because we consume more diesel per capita than just about any other country. And the reason for that is we're a very large country. So again, to move goods around, you have to move goods a very long distances, which means, diesel trucks, diesel trains. So you use a lot of diesel. We've also obviously got a very intensive agricultural sector and a very intensive mining sector. And they also both use a lot of diesel. And that's the charts in the middle there. You can see the industrial oil use. So transport, massive users of diesel, jet fuel. Mining, huge users of diesel. Agriculture, huge users of diesel. Even construction's a pretty big user of diesel, and utilities as well. So, these higher fuel costs are going to feed inflation across the economy. And we're starting, and the RBA basically warned that we're going to start getting those second round impacts, whereby businesses, because of the higher fuel costs, start raising their prices and passing on the cost to consumers. And that just means that we're going to be in this world of pain with inflation for, the period ahead. And if the war in the Middle East doesn't resolve quickly, which is the federal budget's base forecast, and it ends up becoming prolonged, the pain's going to be worse. And the RBA is basically said in their minutes that, and also last week, or after the last meeting, I think that was 2 weeks ago now, I'm sort of losing track of time. 2 weeks ago, the RBA Governor, Michelle Bullock, said that, they're going to have to tighten monetary policy to counteract these forces. So, it's going to get worse. We're going to have higher inflation, prolonged inflation, and we're going to have more rate hikes, more than likely. And that's obviously not just bad for the economy, but it's obviously going to be pretty bad for the housing market as well.
Absolutely. And I think it's just worth highlighting Michelle Bullock in the press conference talked about those different cycles. The first order, the direct impact of the fuel, the rate hike that she did wasn't anything to do with that. It was already embedded in the decisions that had been taken previously. The second round that she was worried about, but the third round, which is the broader issues of unemployment and those sorts of things, will work through potentially. And that actually creates a very uncertain environment. And, uncertainty, unfortunately, also has a flow over onto the property market too, in a further potential negative step down. Leith, I think we've come to the end of the show. I want to say thank you very much for all your work on the charts and, as always, a great articulation of what's gone in. If people want to find out more about you, where do they go?
Okay, so they can go to macrobusiness.com.au. That's sort of the mothership where I write every day. Also, YouTube channel, just type my name, Leith van Onselen, you'll find it, or it's at Leithvo. Pretty much just put up all my media interviews. You also find me on some other random places now. I did the Carl Stefanovic show last week, 1 hour interview with Carl and Clive Palmer, would you believe? It's done about 170,000, I think, on YouTube. It's been very popular. So, that was one of my better interviews. And also I did an interview earlier today with Mark Boris, the founder of Yellow Brick Road and Wizard. He's a ripper bloke. We chatted for about an hour on the budget. So that should hopefully go up, I think tomorrow or Thursday. Wednesday or Thursday this week. So you can watch that as well if you want. That'll be on his channel. I'm pretty much, I'm kind of in my uphill trajectory at the moment, just saying yes to everything and doing a whole bunch of shows and whatever, just because it's, strike while the iron's hot. So, but those are the places, Macro Business, Leith van Onselen on YouTube, or just random places around the internet.
Well, terrific, Leith. Well, thank you very much, and I'll get you back on next month again because I love having these conversations. I love going into the data, but also thinking about the implications, and clearly there are many implications. Thank you very much. Congratulations on all the recent media work. Keep it going, and we'll catch you again soon.
Yeah, cheers, mate. I'll speak to you next time.
Cheers. I'll take you offline and I'll close the show there. I hope you found that informative and interesting. I certainly did. I'll be back next week with a show specifically, I think, on property, but haven't quite worked out the shape of that yet. So keep an eye on that. And of course, the daily shows will continue to be made. Another one coming out tomorrow. And so it goes on. Always more to talk about. The dogs are still here. Yes, they are. Oops. push the right button. The dogs are still here. They have moved the other way, so I have to shift the camera around. There you go. So that's the dogs, and I think it's walkies time, so that's my next plan. Thank you very much for spending time with us this evening. Please like and share and subscribe if you haven't done so. Thanks for all the comments in the chat, and we look forward to seeing you on the next live show next Tuesday. This is Martin North from Digital Finance Analytics signing off. Take care.